Hello and welcome to Session 6 of the Basic Tax course. We're going to begin Session 6 with a review of the Session 4 quiz answer key. I have in front of you now the Session 4 quiz, and I will review the most frequently missed questions, beginning with question number 1. If you give address you made to your landlord to pay the rent on your home, you must include the fair market value of the rent as income on your tax return. That is a true statement. When you trade address that you made for free rent, you are in fact engaged in a barter transaction. And trade of property for property can create taxable income. And in this case, we are trading a service for property. The property is therefore income to the service provider, and in this case, self-employment income to boot. Question number 3 was the next most frequently missed question. Which of the following would disqualify a taxpayer from filing Form 1040-EZ? It provides $100,000 of taxable income, $100,000 of gross income, dividend income, and interest income as the possible choices. Well, it happens to be that $100,000 of gross income would almost never give you $100,000 of taxable income. Remember how I showed you earlier in our course that you typically start with your income and subtract out your standard deduction and your personal exemption amount, and therefore it would be virtually impossible, although I can think theoretically, hypothetically, of situations where income and taxable income would be the same. It's safe to say that in nearly every situation, your taxable income will be less than your gross income. So for that reason, I have said that the correct answer to this question is E, both A and C. So $100,000 of taxable income does throw you off the tax tables and into the tax rate schedules. It also throws you off of 1040-EZ and 1040-A and onto the long form 1040. So A is a reason that you would not be able to file 1040-EZ. Now, the next thing we have is dividend income, and dividend income cannot be reported on 1040-EZ either. Interest income can be reported on 1040-EZ, and that is why the correct answer to this question is E, both A and C. Scrolling down, the next most frequently missed question was question number 5. Capital gain distributions are generally taxable at a maximum rate of 20%. That is false. The maximum capital gain rate is in fact 15% in most instances. Number 6 was also a frequently missed question. Your $12,000 inheritance from your aunt is fully taxable to you. That is false. If any kind of inheritance tax is owed on inheritance, it is payable by the estate. The estate is responsible for that tax and not the beneficiary who receives the inheritance. Question number 7. You are a partner in an investment group and you receive Form 1065-K1. You should file Form 1040-A and report your share of the partnership income as dividend income? I don't think so. Schedule K1 automatically triggers the long Form 1040 because the Schedule E page 2 has to be attached. And then the income, whatever form it is going to flow through to the correct line for character. So if you had a K1 that was showing dividend income, then that dividend income would flow through to the dividend line naturally. But if the K1 is showing interest income, or the K1 is showing ordinary income or loss or rental income, each of those income types has to flow through to the tax form 1040 on the correct line. So when you have a K1, it is showing flow-through items. And those flow-through items retain their character. If the K1 says it has dividend income, then you would report it on the dividend line. If it says that it has interest income, it would flow through to the interest line. If it says it has rental income, it would flow through to the rental line, and so forth. But just this general statement, you receive a K1 and you should file 1040-A and report it as dividend income, that's just completely false. Moving on to the next most frequently missed question. Question number 9. Tony received $1,200 of interest income for the year. Tony also paid an early withdrawal penalty of $500 on a certificate of deposit he had at his credit union. How should Tony report these items on his tax return? Well, the only correct answer here is C, and let's think about what's going on. The IRS says if you have interest income, you need to report it in full, and you would report it in full on line 8A of the Form 1040. The $500 that he paid as a penalty because he withdrew the money early does not reduce the amount of interest income he receives. The early withdrawal penalty is actually claimed on Form 1040 on line 30. So he would enter $500 on line 30 as an adjustment to income, and he would enter the full $1,200 of interest income for the year on line 8A. Number 10, Marcy opened a bank account at XYZ Credit Union where she deposited $5,000 and received a $12 ticket to the Natural History Museum as a gift. Marcy's 1099 INT reports she earned $290 of interest. How much interest income must Marcy report on her tax return? Well, the correct answer is $290. The reality is that the gift itself is not taxable because she has $5,000 that she entered into or deposited, and she can receive a gift valued at $20 or less and not pay tax on it. So the reality is the gift is not taxable. But let's just suppose the gift were taxable, then the taxable gift would be reported on the interest statement. So the 1099 INT would need to include that income as interest income, and so for all of those reasons, the answer is still $290. The next most frequently missed question was question number 12. U.S. savings bonds are taxable on? Well, U.S. federal bond interest is taxable on the federal return. It is not taxable on the state return. And question C is false because, yes, it is taxed on the federal, but it is not taxed on the state. Number 13 is the next question. Generally, return of capital dividends is not taxable. That is a true statement, and most people answered that as false. When you have a return of capital, it's really a return of your original cost, and therefore a return of your cost is not taxable to you. If you receive capital gain dividend or if you receive capital dividends that are a return of capital that are in excess of your cost, then you might get into a taxability situation. But in general, the return of capital dividends is not a taxable event. On the next page, the next most frequently missed question was number 16. Life insurance dividends must be reported as taxable income. That is false. Life insurance dividends are typically also a return of cost or a reduction in premium, and neither of those creates a taxable event. Number 21, how much interest must you receive from a single individual or institution before you will receive a 1099 INT? The correct answer to that is $10. And that's just a preset amount that the IRS has with financial institutions. If they pay you $10 or more of interest during the year, they are required to give you a 1099 INT. But if you received less than $10 of interest for the year, the institution is not required to give you a 1099 INT. Now, whether or not you get the 1099 INT, the interest is still taxable. So even if you only got $1 of interest, you are supposed to report it on your tax return as income. But it's the $10 point where most financial institutions issue 1099 INTs, although some institutions choose to issue them at lower amounts, they are not required to. And that concludes the review of the Session 1 quiz, Session 4 quiz, most frequently missed questions. At this point now, we're going to move on to a review of the Session 5 homework answer key. So let me just pull that up, and let's just review the assignment first as well. The first assignment involves Fred Flintstone married to Wilma Flintstone. They're filing jointly. They have 1099Rs and 1099 INTs reporting income. So the income on the 1099 INT shows Box 1 interest, which is ordinary interest of $2,500, and Box 3 interest of $5,000. Both those amounts are fully taxable on the federal return, and going over to the 1040, we would ultimately on line 8A report a full $7,500 of interest income. Next, we see the Flintstones are not receiving a making work pay credit because they did not have earned income, and that will just mean that we don't make an entry of $400 or $800 on page 2 of the 1040 form. Our instructions are to prepare their federal return, and here is the Social Security statement for Fred Flintstone. It shows benefits of $6,000. Here is Fred's 1099-R. It shows a gross distribution of $18,800, taxable amount $17,000. Wilma has received Social Security benefits of $3,000, and her pension statement shows $16,000 of taxable income. So let's take a look at the answer key for their return. The return really is quite straightforward, and as I've already said, they're going to be reporting $7,500 on line 8A for interest income, and they are going to need to show $18,800 of gross distribution from Fred's retirement plan on line 16A. And Wilma's pension plan is fully taxable and will also be included on 16A, but the taxable amount to report on 16B will be less because Fred's taxable distribution is less than his total distribution. So ultimately, we enter $34,800 on line 16A, and we enter $33,000 on line 16B. They have a total of $9,000 of Social Security benefits, but we need to do the Social Security benefit worksheet to figure the taxable amount of Social Security benefits they received. I'm just scrolling through to that Social Security benefits worksheet, and while I'm on the way, we're passing through a Schedule B that we prepared for the Flintstones. The Flintstones had $1,500 or more of interest income, so Schedule B is required. Again, we've checked no to the foreign account questions, and that $7,500 has carried over to line 8A. Now here is their Social Security benefits worksheet. And here is the Social Security benefits worksheet for Fred and Wilma Flintstone. The first step is to take the total Social Security benefits they received jointly for the year, $9,000, and divide that in half. We get $4,500. We then look to their other taxable income. There was $33,000 of pension income and $7,500 of interest income. Those two amounts total $40,500. We add those to half the Social Security benefits and arrive at $45,000. Now we start to do some computations, and the first computation is to pull this base amount of $32,000 and subtract it from their $45,000 of income. We get $13,000. Then we look to see the second amount or number that is printed on the form, $12,000, and 13 exceeds 12. We do that subtraction and get $1,000. We then enter the smaller of line 10 or line 11. In this case, line 11 is the smaller number, so we enter that $12,000. We're then asked to divide that by 2, and we get $6,000. Next step is to look to line 2 and to line 14 and choose the smaller of those two numbers. Line 2 is smaller, so we enter it, and that's $4,500. We then multiply line 12, which is $1,000, by 85%, and we get $850. We add that to the amount on line 15, and we get $5,350. Now we look at the total amount on line 1, $9,000, multiply that by 85%, and enter the total, $7,650 on line 18. That is the maximum amount of taxable benefits the Flintstones could have regardless of their income. But because their income is low enough, they ultimately take the lower of line 17 or 18, and in this case, 17 is the lesser amount, and that is the taxable benefit they have for the year, $5,350. We now take that $5,350 and enter it on page 1 of the 1040. Right here on line 20B, you'll see it. We enter the total benefits on line 20A, the taxable amount on line 20B. You can see here also the pension at $34,800 and the taxable amount at $33,000. Their total income for the year is $45,850. We move on to page 2 of the return. We figure their standard deduction, which is $13,600. Remember that they're getting additional standard deduction amounts because both of them are age 65 or older. They are allowed a personal exemption totaling $7,300, and we then get taxable income of $24,950. The tax tables show that that tax amount on that income is $2,909. So we enter that on the form. They had $1,600 withheld, so they owe $1,333 for the year. So that concludes the review of the first homework assignment for session. Moving on, homework Homework assignment B. Betty Rubble will be filing married filing separate. Her husband Barney does not itemize his deductions. And during the year, Betty received $1,500 of interest from her Port of Seattle bonds. She also cashed in and received $500 of interest on her Series EE savings bonds, which she used to pay for higher education. In February 2010, Betty began full-time studies at Texas A&M University. She withdrew $4,000 from her IRA, of which she spent $3,000 on tuition and fees. Her 1099-R is attached. She will receive a $400 making work pay credit. Here is her W-2 for $9,000. And here is her 1099-R. You'll observe that she has a gross distribution of $4,000, all of which is taxable. The distribution code is 1, meaning early, no known exception to the early withdrawal penalty, and the IRA SEP box is checked. So let's take a look now at the answer key for Betty. Now, let's just go through some key points here. Betty is married filing separate, and as such, she is entitled to none of the tax benefits associated with higher education expenses. She may not exclude her U.S. bond interest, and she is not entitled to claim the tuition and fees deduction or education credits. However, she can exclude the portion of her education expenses that were spent on tuition and fees from the penalty on the early withdrawal from her IRA. So let's go take a look at the 5329. And in reviewing the form, we will enter the total amount that she had as an early distribution from her IRA that is going to be included in her income. And then we have an early distribution exception. The exception code for higher education for IRA distributions is code number 8. We enter code number 8. The amount she spent on higher education was $3,000. $3,000 is less than the total distribution, so $1,000 is still subject to the penalty. The penalty is 10% of $1,000 or $100. We go back up to the 1040 and finish off her return. We see that her filing status is married filing separate, and we're going to enter the name of her spouse, Barney Rubble. Her income is $9,000 from wages, $500 from U.S. savings bonds, and $1,500 of tax-exempt interest because the Port of Seattle bonds are tax-exempt at the federal level. Her IRA distribution of $4,000 is taxable and is included in her income, giving her total adjusted gross income of $13,500. Moving on to page 2, her standard deduction is $5,700. Her personal exemption is $3,650. Her taxable income is $4,150, and the tax on that from the tax tables is $418. We're not done. We do need to enter that $100 early withdrawal penalty, and giving her total tax of $518. She had $1,200 of withholding, $400 of making work pay credit, so ultimately she has a refund of $1,082. So that concludes the review of the Session 5 homework assignment. It is now time to push pause on this video playback and take the Session 5 quiz. When you are finished taking the Session 5 quiz, please resume video playback and we will proceed with the lecture for Session 6. Okay, by now you should have completed the Session 5 quiz. If not, please push pause and take the quiz. But if you have, we're ready to carry on with Session 6. Session 6, I always like teaching topics that involve deductions. I just like saving people money. So while it's all well and interesting to talk about income and how it's taxed, when we get on to deduction items, I always get rather excited. I also like credits a lot for the same reason. So today's topic, though, is adjustments to income. And adjustments to income are special because these are deductions that are claimed on the front page of the tax return. And if we look here at the 1040 form, we'll see that lines 23 through 37 are devoted to, or actually 23 through 36, rather, are devoted to calculations of adjustment items, which can be claimed on the front page of the return. Other types of deductions, including itemized deductions and credits, are claimed on page 2 of the tax return. So these are the deductions we're going to cover today: educator expenses, business expenses of reservists, performing artists, and fee-basis government officials, health savings accounts, moving expenses, 1/2 of self-employment tax, self-employed SEP simple and qualified plans, self-employed health insurance deduction, penalty on early withdrawal of savings, alimony, IRA deduction, student loan interest deduction, and the tuition and fees deduction. By the end of today's session, you should understand the term adjustment to income and how it compares to other deductions. You should have learned who is eligible to claim an IRA deduction and how to calculate the tax basis in your traditional IRA account. You should know how to deduct alimony paid, know which moving expenses can be deducted, and how to complete Form 3903, and you should know how to deduct certain tuition expenses and student loan interest. Let's look at some definitions first. And the first definition is the adjustment to income meaning itself. Adjustments to income are claimed on Form 1040, lines 23 through 36, and they are commonly referred to as above-the-line deductions. Adjustments to income allow you to deduct certain expenses from your gross income without the requirement for reporting them on Schedule A. In recent years, the number of deductions available as adjustments to income has increased because Congress and Presidents Clinton and Bush have pushed to make certain deductions available to a greater number of filers. Just on a political note, the government is currently looking at increasing overall tax revenues, and a number of adjustment items I suspect are going to be targeted. Even if they are not targeted in the near term, a number of these deductions will be phasing out or are expiring, rather, at the end of 2012. So this course is covering 2010 tax law, and the rules that we're discussing surrounding adjustments to income are likely to continue through tax years 2011 and 2012, but a number of them are sunsetting or expiring after 2012, and in addition, I expect a number of these items to be targeted by our federal government as it looks at addressing tax revenues. But as we sit here today, these are the rules. So, in a nutshell, adjustments to income. In a nutshell, adjustments to income are deductions that you can use to reduce your adjusted gross income. They are different from itemized deductions because they are a direct subtraction from your income on the front page of 1040 or 1040A. Itemized deductions, which we will discuss later in this course, can be claimed instead of your standard deduction, but not in addition to it. Adjustments to income can be claimed in addition to your standard or itemized deduction. Educator expenses, line 23. The deduction for teacher classroom materials. So let's take a look at the first of these. So we're going to be taking most of these adjustment items in the order that they appear on the 1040 form. And the first item on the 1040 form is the educator expenses on line 23, and that is where we are right here. So the deduction for classroom teacher materials. If you are an eligible educator, you can deduct as an adjustment to income up to $250 in qualified expenses on Form 1040, line 23, or Form 1040A, line 16. You must be an eligible educator to claim this deduction, and an eligible educator must meet the following requirements. They must work with kindergarten through grade 12 as a teacher, counselor, instructor, principal, or aide, and they must work at least $900 during a school year in a school that provides elementary or secondary education as determined under state law. The deduction is not available to homeschool teachers. Also, you must have qualified expenses. Qualified expenses include unreimbursed expenses that you paid for books, supplies, other than non-athletic supplies for courses of instruction in health or physical education, computer equipment, including related software and services, or other equipment and supplementary materials used by the educator in the classroom. The next item we're looking at is certain expenses of reservists, performing artists, and fee-basis government officials. Those are claimed on line 24 of the 1040 form. Performing artists first. Certain performing artists can claim their qualified employee business and educational expenses as an adjustment to income rather than as an itemized deduction. To qualify, all of the following must apply. During the year, you performed services for 2 or more employers. You were paid at least $200 each by 2 or more employers. Your related performing arts expenses are more than 10% of your income for performing those services, and your adjusted gross income is not more, get this, than $16,000 before deducting these business expenses. So really, this performing artist deduction is available to a very small number of people, and if you've ever heard the term starving artist, well, it would only be a starving artist that could ever qualify for this deduction. So remember those rules. 2 or more employers on a W-2. The expenses have to be more than 10% of your income, but your income can't be more than $16,000 for the year. If you meet all of those criteria, you claim the deduction on Form 1040, line 24, but you do need to attach Form 2106 or 2106OZ to your EZ to your return. Next is the fee basis government official deduction. Fee basis officials are persons who are employed by a state or local government and who are paid in whole or in part on a fee basis. They can deduct their business expenses in performing services in that job as an adjustment to gross income rather than as a miscellaneous itemized deduction. How to claim the deduction? Claim the deduction on Form 1040, line 24, and attach Form 2106 or Form 2106EZ. These are forms that we're not going to be covering in today's class, but we will get to Form 2106 in our session on itemized deductions, employee business expenses. Deduction for overnight travel expenses of National Guard and Reserve members. Reservists who stay overnight more than 100 miles away from home while in service, for example for a drill meeting, may claim an above-the-line deduction for the following unreimbursed travel expenses, including transportation, meals, and lodging. The deduction is limited to the rates for such expenses authorized for federal employees, including per diem in lieu of assistance. And in terms of what that means, we will also cover that in our itemized deduction session on employee business expenses. How to claim the deduction? Well, if you qualify for the deduction, you claim the deduction on Form 1040, line 24, and you attach Form 2106. And again, Form 2106 is a form that is normally associated with employee business expenses, and it normally attaches to Schedule A. The special thing about reservists and fee-basis government officials and qualifying artists is that this deduction is being allowed above the line. So rather than having the Form 2106 flow through to the Schedule A, it actually flows through to the front of the tax return. The next deduction in line is health savings accounts, which are claimed on line 25 of the Form 1040 form. Right here, line 25. So what is a health savings account? Well, an HSA is a tax-exempt trust or custodial account established exclusively for the purpose of paying qualified medical expenses of the account beneficiary who, for the months for which the contributions are made to an HSA, is covered only under a high deductible plan. Who is eligible to establish an HSA? Well, an eligible individual is an individual who in any month is covered under a high deductible health insurance plan on the first day of that month, and not also covered by any other health plan that is not a high deductible plan, with certain exceptions for plans providing certain limited types of coverage. And a limited type of coverage might be, say, you have AFLAC, which offers a little bit of extra insurance coverage if you get an injury or for dental purposes and so forth. Also, you cannot be enrolled in Medicare, and generally that means you have not yet reached age 65, and you have not claimed, you are not claimed as a dependent on another person's tax return. So what is a high deductible health plan? Generally, an HDHP is a health plan that satisfies certain requirements with respect to deductibles and out-of-pocket expenses. The amounts for 2010 are, for individuals, an HDHP has an annual out-of-pocket deductible of at least $1,200, and maximum expenses to be paid by the individual are not to exceed $5,950. For families, a high deductible health plan has an annual deductible of at least $2,400 and annual out-of-pocket expenses required to be paid by the family do not exceed $11,900. For family coverage, a plan is an HDHP only if coverage is not provided to any family member under the plan until the deductible of $2,400 has been met. Copays and preventative care coverage. A plan does not fail to qualify as an HDHP merely because it does not have a deductible or has a small deductible for preventative care. For example, first dollar coverage for preventative care. However, except for preventative care, a plan may not provide benefits for any year until the deductible for that year has been met. And here is an example. Plan A provides coverage for Jack and his family. The plan provides for the payment of covered medical expenses of any member of Jack's family if the member has incurred medical expenses during the year in excess of $1,500, even if the family has not incurred covered medical expenses in excess of $2,400. If Jack himself incurred covered medical expenses of $2,000 in a year, the plan would pay out $500. Since benefits are potentially available under Plan A, even if the family's covered medical expenses do not exceed $2,400, the plan is not a qualifying HDHP. Let's look at another example, though. Example 2. The same facts as in Example 1, except that Plan A has a family deductible of $5,000 and provides payment for covered medical expenses if any member of Jack's family has incurred covered medical expenses during the year in excess of $2,400. The plan satisfies the requirements for an HDHP with respect to the deductibles. So how much can you contribute to your HSA during the year? Well, if it's a self-coverage only plan and you are under age 55, you can contribute up to $3,050 for the year. If you are age 55 or older, you can contribute as much as $4,050 due to a $1,000 catch-up allowance. If this is a family plan and you are under age 55, the maximum amount that you can contribute during the year is $6,150. However, if you are age 55 or older, you can also claim a catch-up amount of another $1,000, taking it to $7,150. But bear in mind, if one spouse meets the age requirements, an additional catch-up contribution of $1,000 is allowed. But if both spouses meet the age requirements, the maximum catch-up contribution amount is increased to $2,000, and that would make the maximum total allowed contribution $8,150. So essentially, what is going on with an HDHP? Well, here's what is intended to go on. You have a high deductible plan. But the plan does not cover you until you've met the deductible, and the deductible can be quite substantial. So how do you deal with that? Well, you open up a health savings account and you make contributions to that account. And ideally, the contributions you're able to make to the account are equal to the deductible for the account, or even a little bit larger in these situations here that you see based on the limits for self and family. So let's suppose you have a $4,000 deductible on your family plan, and during the year you were able to contribute $6,100 to the plan, and you did contribute $6,100 to the plan. You would be able to withdraw money from the plan for purposes of paying the deductibles that you had. So ultimately, you would be able to use tax-free money to pay your medical bills. So there can certainly be some benefits to the health savings account option. Now, the amount that you can contribute to your health savings account is reduced by any amount that you contribute to an Archer MSA, or medical savings account, or any employer contributions to the HSA that were excluded from your income. Also, transfers from an individual's IRA to the HSA. And finally, if either spouse has family coverage, both spouses are treated as having family coverage with the lower annual deductible of the two health plans. So how to claim the deduction for health savings contributions? Claim the deduction on Form 1040, line 25, and attach Form 8889. So there we are, line 25. So who must file Form 8889? That's the next topic we're going to look at. You must file Form 8889 if any of the following applies. You or someone on your behalf, including your employer, made contributions for 2010 to your HSA. You received HSA distributions in 2010. You acquired an interest in an HSA because of the death of the account beneficiary. Or you must include certain amounts in income because you failed to be an eligible individual during the testing period. So here is the form. It is a multi-part form, as most are. And in Part 1, you use Part 1 to figure your HSA deduction, any excess contributions you made or those made on your behalf, and any excess contributions made by your employer. If you receive a Form W-2, Box 12, Code W, will tell you that your employer made contributions to your HSA for you, or they made tax-free contributions from your payroll, or you made a payroll deduction that went to your HSA that was tax-free. So employer contributions to your health savings accounts are reported in Box 12 of your W-2, and you report the amount shown in Box 12 of your Form W-2 on Form 8889, line 12. You use Part 2 of Form 8889 to report distributions from your HSA. You enter the total distributions you received in 2010 from all HSAs. These amounts should be shown in Box 1 of Form 1099 SSA. So essentially, anytime you put money into your HSA, you complete Part 1. Anytime you take money out of your HSA, you complete Part 2. And it is possible that you would put money in and take money out in the same year, and then you would complete both parts. Please be aware of certain situations where you are deemed to have taken a distribution from your HSA. The following situations result in deemed taxable distributions from your HSA. Number 1, you engaged in any transaction prohibited by Section 4975 with respect to any of your health savings accounts at any time in 2010. Your account ceases to be an HSA as of January 1, 2010, and you must include the fair market value of all assets in the account as of January 1, 2010 on line 14A. You used any portion of any of your HSAs as security for a loan at any time in 2010. You must include the fair market value of the assets used as security for the line as income on line 21 of your Form 1040. Any deemed distribution will not be treated as used to pay qualified medical expenses. Generally, these distributions are subject to the additional 10% tax. But note, for tax years beginning after December 31, 2010, the additional tax increases to 20%. There are some exceptions to that 10% tax. The 10% tax does not apply to distributions made after the account beneficiary dies, becomes disabled, or turns age 65. If any of the exceptions apply to any of the distributions included on line 16, check the box on line 17A and enter on line 17B 10% of the amount included on line 16 that does not meet any of the exceptions. And of course, these line numbers that are being mentioned in this box are referring to the line numbers on Form 8889. Here is Form 1099 SSA, distributions from a health savings account, Archer MSA, or Medicare Advantage MSA. If your client brings this in, Box 1 is going to show the gross distribution, Box 3 will show the distribution code, and then Box 5 will indicate what kind of health savings account this was, include the distribution in your income. The next topic of the day is moving expenses. And at some point, everyone moves, don't they? And so moving expenses is something that actually comes up fairly routinely. And it should be really a part of the standard interview procedures you go through with any client, asking them if they moved during the year. Now, I word my question a little more carefully. I say, did you move more than 50 miles during the year? And we'll see why. Moving expenses, line 26 of the Form 1040. And that is what we're moving on to now. You may be able to take a deduction for certain job-related moving expenses. If eligible, you must complete Form 3903 and claim your allowable expenses as an adjustment to income on line 26 of Form 1040. Here are the requirements for claiming moving expenses as a deduction. Generally, you must begin to work at a new job within 1 year of the date of your move. Generally, you must also meet the time test. Employees must work full-time at least 39 weeks during the first 12 months, and self-employed people must work full-time at least 39 weeks during the first 12 months and 78 weeks during the first 24 months. Generally, you must meet the distance test. Your new main job location is at least 50 miles farther from your former home than your old main job was from your former home. And if you go to work for the first time, your new job must be at least 50 miles from your old home. Now, I wanted to look at this distance test and kind of highlight something which is rather important just in the wording here. And it is this word right here. Your new main job is farther from your former home than your old main job was from your former home. So it's looking at the job and how far the job was from the home and how far the new job is from the former home. So you've got your old job in, let's just say, Lexington, Kentucky, and then you move to a new job in another city. The question is the new job, or pardon me, is the home that you lived in more than 50 miles further from the new job than it was from the old job? And it's not looking at the distance you move from one house to the next house, but rather how far your old house is from the new old job and how far your old house is from the new job. Hopefully that makes sense to you. So let's look at some exceptions to the time test. Because, of course, the time test is up here, 39 weeks in the first 12 months or 78 weeks during the first 24 months if you're self-employed. Exceptions to the time test: you do not meet the time test if any of the following apply. Armed forces. Pardon me, you do not need to meet the time test if any of the following apply. Armed forces. You are in the armed forces and you moved because of a permanent change of duty station. Retirement. You moved to the United States because you retired. Survivors. You are the survivor of a person whose main job location at the time of death was outside of the United States. Death or disability. Your job at your new work location ends because of death or disability. Transferred or laid off by your employer. You are transferred for your employer's benefit or laid off for a reason other than willful misconduct. You must have obtained full-time employment and expected to meet the time test at the time you started the job. So let's take a look at this chart. It comes straight out of Pub 17, and it does a very good job of explaining that home test I was talking about for terms of distance test. So here's the former house and how far the old commute was, 3 miles to the old work location. If your old house is less than 50 miles from the new location, it's automatically not going to qualify because it couldn't possibly be 50 miles more than the distance to the old. So if we take 38 and minus 3, we only have a 35-mile increase in the commute. But the new job location in this second arrow pointing at this building is 58 miles further than home. If you take 58 and minus 3, you still have 55. And so that would make this job more than 50 miles farther from the old home than the old job was from the old home. And therefore, the deductions are allowable. So what is deductible? We've talked about the tests, and let's assume you meet the tests for claiming deductions. What are you allowed to deduct? If you meet the requirements for claiming moving expenses, you can deduct the reasonable costs of moving your household goods and personal effects, including in-transit or foreign move storage expenses, and traveling, including lodging but not meals, to your new home. Allowable costs of moving household goods: packing, crating, and transporting household goods and personal effects of yourself and members of your household from your old home to your new home. Storing and insuring household goods and personal effects within any period of 30 consecutive days after the day your things are moved from your former home and before they are delivered to your new home. The cost of connecting or disconnecting utilities required because you are moving your household goods, appliances, or personal effects, and the cost of shipping your car to your new home. The cost of shipping your household pets to your new home as well, and the cost of moving household goods and personal effects from a place other than your former home to the extent that the cost does not exceed what it would have cost to move them from your former home. So let's kind of talk about these things a little bit. You have movers come in, and they pack and crate and then ship all of your household goods for you. That's a deductible expense. Or it could be you purchase packing materials, pack all of your stuff, load it in a U-Haul, and drive it yourself. That, too, is deductible. Now, let's suppose you've moved out of your house and now you're transporting yourself and all of your goods to your new location, but you're not able to move into your new home right away. And so you put your items into storage to wait for a period of time when you can move into your new home. IRS says you can deduct the cost of storing your household goods for up to 30 days, but anything over 30 days would be a non-deductible expense. They're not saying you're not allowed to store your household goods. That's not the case. They're simply saying that if the storage goes more than 30 days, it's not going to be deductible beyond 30 days. Also, the cost of connecting and disconnecting household utilities, that is deductible. The cost of shipping your car. So you could drive your car to your new home and claim the cost of driving it, or you could pay someone to ship it for you. Either way, it's deductible. Let's suppose you have a pet and you have to put it on an airline and ship it across country. Not a problem. You are allowed to deduct that cost as well. And finally, the cost of moving household goods and personal effects from a place other than your former home, to the extent that cost does not exceed what it would have cost to move them from your former home. So let's just suppose you have some items in storage in your hometown, but they're not in your house. You're paying to store them somewhere. And the movers come and they load a bunch of stuff from your home and take them to your new home. And as a part of that, they also pick up and transport the other items, and there are additional costs associated with transporting those other items. The question would be, is the additional cost associated because it's making the shipment larger and they charge you by the pound, or is there also an additional charge because they went to a second location and did a second pickup? IRS is saying if the cost is the same as it would have been if it came from your main home, then it's fine. But to the extent it's extra, you can't claim that extra amount. Allowable travel costs. So we've looked at the cost of shipping your household goods. Now let's look at the cost of transporting yourself and your family to your new home. Transportation and lodging for yourself and members of your household while traveling from your former home to your new home, including expenses for the day you arrive, are allowable expenses. If you drive your car, you can claim the actual cost of gas and oil paid during your move, or you can claim a standard mileage allowance of 16.5 cents per mile. Lodging expenses in the area of your former home within 1 day after you could no longer live in your former home because your furniture had been moved are also deductible. So you're allowed to claim the cost of lodging you incur along the way. You're also allowed to incur the cost of transporting yourself along the way. And for the day you move out of your house, you may not be on the road yet, or you may not be on a plane yet, but maybe you're in a hotel because you don't have a bed to sleep in at home anymore. And the IRS says that's okay. Also, when you arrive at your new home, you can get that one night when you arrive at your new home if you weren't able to move in right away. But anything beyond the night you move out or the night you arrive, you're not allowed to claim. So if you have temporary housing expenses while you're waiting for your new home to be ready, those temporary expenses are not allowable. And number 3, you can deduct expenses for only one trip to your new home for yourself and members of your household. However, you do not have to travel together or at the same time. So it may be that you have 2 cars or even 3 cars, or it may be you travel ahead of your spouse and your spouse comes along later. IRS really doesn't care about that. Each of you individually will incur costs of traveling, and those costs are deductible. But what is not deductible? Well, there's a lot of stuff that's not deductible, and it's routine for clients to ask about these deductions, so you should get it in your head what they can't claim, because actually when you think about it, the list of what they are allowed to claim is pretty small. You are not allowed to claim any part of the purchase price of your new home. You cannot claim the cost of getting new tags for your car, or a new driver's license, or any of the expenses associated with buying or selling your home, or of getting out of or breaking a lease. Nor can you claim home improvements that you put into your house in order to help you sell it, or any loss you might incur because you sold your home, or losses from deposits of memberships in clubs you might have had in your area, or the cost of meals along the way, or mortgage penalties, or pre-move house hunting expenses, or real estate taxes, the cost of refitting carpets and draperies, or security deposits, including any given up because of the move. You cannot claim storage charges except those incurred in transit and for foreign moves, nor can you claim temporary living expenses. Also, no double deductions. You cannot claim a moving deduction and a business expense deduction for the same expense. What they're getting on with that there is, let's just suppose you have some office furniture If you claim that office furniture as a deduction on 3903, you cannot also claim it as a deduction on Schedule C for self-employment. But to the extent you do have self-employment expenses for moving costs, those moving costs can be claimed on Schedule C, and if you claim them there, you cannot duplicate them on Form 3903. Next up is employer-paid moving expenses. This is quite common, and you should be aware of the rules. Your employer may pay all or part of the cost of your move. You may only claim a deduction for allowable expenses that exceed your employer-paid expenses. Non-deductible moving expenses paid by an employer on behalf of an employee are a taxable fringe benefit. If your employer paid non-deductible expenses for you, your employer must include the cost of those non-deductible expenses in your income. The most common non-deductible expenses paid by employers are house hunting expenses, real estate sales expenses, temporary living expenses, and meal expenses while living and traveling, in temporary quarters and traveling. Employers who pay non-deductible moving expenses for their employees will often give the employee additional moving pay. This added pay is used to pay the extra taxes the employee will owe because of the gross up in income from the non-deductible reimbursements. And here's an illustration of what I mean by that. So now, if you're essentially paying for your own moving costs, you're going to have a pretty tight handle on, hopefully, if you kept receipts and so forth, you're going to have a pretty tight handle on what you actually paid for your move. But when you are working and your employer pays your costs for you, your employer may have a pretty big budget to get you. Certain employees are very much desired by an employer, and an employer is willing to pay a lot to get them to a particular work location. And an employee may say, hey, I'm not going to move to a new city and tear up my roots and lose money on my house and incur, all of the hardships associated with moving if you don't pay me a bunch of money for that. And so the employer may say, well, we're going to pay all of the real estate commissions associated with selling your house. We'll pay all of the costs of packing your stuff and shipping it for you. We'll pay any temporary living expenses you have in the new home while you're looking for work, because we want you to come work for us at this location. So the employee says, well, okay, I'll do that. Well, here's the deal, though. If an employer pays non-deductible expenses for an employee, then that non-deductible expense becomes a fringe benefit to the employee, and the employee has to pay tax on it. Well, if you're an employee and your employer gives you a whole bunch of reimbursements for these expenses, free housing and pays your sales commissions for you on the sale of your house, well, you could look at all of that and go, that's a pretty good deal. But if you find out that it's going to mean you have $50,000 of additional income that you're going to have to pay tax on, you could go, whoa, I'm going to have to pay $20,000 on this $50,000 of income. So then what will happen is the employer will say, we'll take care of that. We'll give you an extra $20,000 that you can use to pay the tax you owe on the $50,000, except now they're giving you $70,000, so you'll actually have to pay tax on $70,000. So there's some mathematical formulas they use to figure out how much tax you're going to owe on the fringe benefits and on the taxable gross up. And so in the year of move, some of these highly desirable employees can have pretty big W-2s. And here's an illustration. On January 1, 2010, Johnny Mover is hired by TJ Sports. TJ Sports reimburses Johnny all costs of relocating from his home in Texas to his new home in Washington. TG Sports reimbursed Johnny the following expenses: $3,000 of deductible moving expenses, $8,000 of non-deductible moving expenses, and an additional $4,500 of payroll increase to compensate Johnny for income tax and Social Security and Medicare taxes he will owe on the $8,000 of non-deductible moving expenses that TJ Sports paid for him. Now, Johnny's annual salary from TJ Sports is $75,000. However, because of the moving expense gross up, his W-2 will show taxable wages or total wages of $87,500, and they are calculated as follows. He takes his base wage of $75,000, adds the fringe benefits, adds the additional gross up they give him to pay taxes, and he ends up with a W-2 of $87,500. So here is what the W-2 would look like. It would show his pay for the year, $87,500. In box 12A, they're showing a code P of $3,000. When you see a code P, you're seeing that the employer paid deductible moving expenses for that employee, and those expenses totaled $3,000. There's no entry that you make on the tax return with respect to that because it's not deductible to the employee. But let's just suppose that Johnny had additional expenses that his employer did not pay for him. Perhaps he had an additional $2,000 of expenses that his employer did not pay for him, and they are deductible. Then you would enter those additional expenses on Form 2106. 1/2 of self-employment tax, line 27. This is the next adjustment item we are going to talk about. If you have net income from self-employment, including self-employment income from a Schedule C sole proprietor, partnership income reported on a Schedule K1, wages or self-employment earnings as a church minister, or non-employee compensation reported as other income on Form 1040, line 21. In some cases, you must complete Schedule SE and pay self-employment tax on income reported on a Form 1099 miscellaneous if the Box 3 other income amount is included. Self-employment tax is the equivalent of Social Security and Medicare taxes payable on employee wages. If you are an employee, your employer is required to withhold 6.2% of your earnings from Social Security tax and 1.45% of your earnings from Medicare tax. Your employer must also pay an additional 6.2% Social Security tax and an additional 1.45% Medicare tax on your earnings. So the total Social Security and Medicare tax due on your earnings is 15.3%, and it's broken up as follows. Employee share Medicare, employee share Social Security, employer share Medicare, and employer share of Social Security, total tax 15.3%. But if you are self-employed, you are responsible for paying both halves of this tax. After all, you do not have an employer to pay the employer half for you. You're it, so you pay both. And if your earnings are subject to self-employment tax, you complete Form Schedule SE to calculate what tax is owed. You report your self-employment tax on Form 1040, line 56. So line 56 is where you enter self-employment tax, and that is right here, line 56 of the 1040. Now, why do we care about all of that? When we're talking about an adjustments section, well, anytime you pay self-employment tax, 1/2 of that self-employment tax is deductible on line 27. Now, there are other people beyond self-employed people who have to pay self-employment tax, and one of those is ministers. If you are a minister of a church, your earnings for the services you perform in your capacity as a minister are subject to self-employment tax, even if you perform these services as an employee of that church. So normally, self-employment income is associated with, hey, running your own business and working for yourself. But if you are a minister, even if you are an employee of the church that you work for, you must still pay self-employment tax on your wages. It's rather an odd concept, and it is specific to the clergy. So if you are, but there is an exemption from the self-employment tax. You may have heard about it. If you are a member of a recognized religious sect or a division of a recognized religious sect, you can apply for an exemption from payment of Social Security and Medicare taxes on both your self-employment income and the wages you earn from an employer who also has an exemption. Form 4029 must be filed with the IRS to claim the exemption. Now, here's the deal with this particular exemption. It can be very tempting. I can get out of self-employment tax by filing this form, but it's universally been the case for my clients who are ministers that when I further explain to them that if they claim exemption from self-employment tax on religious grounds, they're also claiming exemption from any potential benefits from the Social Security system when they retire. So most ministers, when they find out that they're actually opting out of Social Security, change their minds and don't file the form. But there may be some ministers who really do on religious grounds say that they don't want to participate in the Social Security system, and if they file that form, they basically are exempting themselves from the tax, but they're also exempting themselves from any benefits under that system. Self-employment tax on minister income, how does that work? All of the following must be included in gross income when figuring the amount of income that is subject to self-employment tax. Firstly, salaries and fees for your ministerial services, but also offerings you receive for marriages, baptisms, funerals, masses, etc. and the value of meals and lodging provided to you, your spouse, and your dependents for your employer's convenience, and the fair rental value of a parsonage provided to you, including the cost of utilities that are furnished by your employer, and any rental allowance, including amounts for payments of utilities paid to you. Also, any amount a church pays towards your income tax or self-employment tax, other than amounts withheld from your salary. So here is an example. Pastor Roy Rogers receives an annual salary of $50,000 as a full-time minister. The $50,000 includes $10,000 that is designated as a parsonage allowance to pay for rent and utilities for his home. Pastor Rogers is not exempt from self-employment tax. He must include $50,000, the $40,000 of wage, plus the $10,000 of parsonage when figuring his net earnings for self-employment purposes. But the $10,000 of parsonage allowance is exempt from income tax and not from self-employment tax. So I'm rather explaining kind of an odd concept to you. If you are a minister, let me just open this form up a little bit more so I can show you what I'm talking about. And you have wage income of $40,000. You would enter the wage income on line 7. The wage income is not subject to, the wage income is subject to self-employment tax if you're a minister. But you can also receive a parsonage allowance of an additional $10,000. So ultimately, you would be assessed self-employment tax on $50,000, even though you're only reporting $40,000 on line 7. So how do you go about deducting 1/2 of your self-employment? Line 27. Now the specifics of the form and how to complete the form are it is deductible on line 27 of the 1040. When we get to self-employment, we will teach you how to calculate the tax and enter it on the return. Self-employed SEP simple and qualified plans, line 28 of the 1040 form. Plan that allows an employer to make contributions toward an employee's retirement without becoming involved in a more complex retirement plan. If you are a qualifying employee, a SEP allows your employer to make deductible contributions to a traditional IRA. That is a SEP IRA for you. Contributions limits for SEP IRAs are larger than for traditional IRAs. An employer can contribute and deduct up to 25% of an employee's compensation, or $49,000, whichever is less. So let's look at how these SEP contribution limits work for self-employed individuals. A self-employed person can contribute to his or her own SEP, but special rules apply. The actual amount of contribution a self-employed individual can make varies according to the contribution rate that is chosen by the individual. The maximum amount a self-employed person can contribute to his or her plan is usually 20% of net SE earnings after subtracting half of the self-employment tax. And here's an illustration of how that would work. Joe taxpayer has $60,000 of self-employment income after deducting 1/2 of his SE tax. The maximum amount that Joe to withdrawal and tax rules that apply to traditional IRAs, and you should refer to Publication 560 for more information about SEPs. Next up is the Savings Incentive Match Plans for employees. These are also referred to as simple plans. For simple plans, an employer generally must either match elective employee contributions limited to $11,500 or $14,000 if age 50 or older annually, dollar for dollar up to 3% of compensation on behalf of each eligible employee, or make a non-elective contribution of 2% of compensation on behalf of each eligible. If you are eligible to claim a deduction for your SEP or simple contribution, claim the contribution as an adjustment to income on Form 1040, line 28. The deadline for making a contribution to a SEP or simple plan is the due date of the return, including extensions. This differs from a traditional IRA, where the deadline for making a contribution, that is April 15th, and filing an extension does not give you more time. A SEP plan can be started and contributed to by the due date of the return, including extensions. Must be established by October 1st, 2000. Is actually October 15, 2011. So that means if you participate, and actually I think October for 2010 contributions to SEP and simple plans, if you file an extension, is actually going to take you to October 17th this year. And for a traditional IRA, it can never take you past the original deadline of the Self-employed individuals may claim a deduction on Schedule C for health insurance claim. Pardon me. Yeah, self-employed in. Self-employed health insurance deduction, line 29. For Schedule C filers, self-employed individuals may claim a deduction on Schedule C for health insurance premiums that they pay for their employees. Self-employed individuals may not deduct health insurance premiums that they pay for themselves or their family members on Schedule C. Note, however, that health insurance premiums paid for an employee spouse are deductible on Schedule C, provided the spouse is an employee of the sole proprietor and is issued a W-2. Now, I should stop right here and point out that this is one of the most frequent errors I see done on tax returns, both by the tax clients themselves and by other tax preparers. So when I'm reviewing a prior year return and I'm looking at a prior year return for self-employment, I'll see that health insurance premiums have been claimed as a deduction and there are no employees of that business. Flat out not allowed. You may not put self-employed health insurance premiums anywhere on Schedule C, nor can you put premiums that you pay for any of your family members on Schedule C. The only exception to that is if you are married and your spouse works for you and you give your spouse a W-2 at the end of the year like you do any other employee you might employ, then the health insurance premiums you pay for your spouse are deductible on Schedule C because your spouse is your employee, and that is a non-taxable fringe benefit that you are allowed to claim a deduction for. Now, the deduction is limited. So if you're not allowed to claim health insurance premiums on your Schedule C, where do you claim them? Well, if you pay self-employed health insurance premiums, you are allowed to deduct them, but only as an above-the-line deduction on the front page of the Form 1040. And in most cases, this is a disadvantage. In other words, it would do you more good if you could claim it on Schedule C, but at least they allow it somewhere, and it's on line 28. Now, the deduction, if you do claim it, is limited to the net profit you have from Schedule C minus the deductions for half of your self-employment tax and contributions for sole proprietor benefit to a SEP simple or qualified plan. A self-employed person may be able to deduct the amount paid for health insurance premiums for himself, his spouse, and his dependents as an above-the-line deduction on Form 1040, line 29. Effective March 30, 2010, the insurance can also cover his or her child who is under age 27 at the end of 2010, even if that child is not his or her dependent. Use the worksheet found in the Form 1040 instructions to determine if this additional deduction is allowed. Next up is penalty on early withdrawal of savings, Form 1040, line 30. If you withdraw funds early from a deferred interest account that has a maturity of 1 year or less, you may have to pay a penalty. You must report the total amount of interest earned as income on your return. You can claim a full deduction for the early withdrawal penalty as an adjustment to income on Form 1040, line 30, even if the penalty is greater than the interest earned. And the next item in line is alimony. And the next item in line is alimony. Alimony is entered on line 31A of the Form 1040, and you must on line 31B enter the Social Security number of the spouse you paid Social Security, or the Social Security number of the spouse you paid alimony to. You can deduct alimony you paid even if you do not itemize your deductions. The rules for deducting alimony are the same as the rules for including alimony in your income. You claim a deduction for alimony as an adjustment to income on Form 1040, line 31A. You cannot claim the deduction on Form 1040EZ or Form 1040A. You must provide your spouse's Social Security number on Form 1040, line 31B, or a $50 penalty may apply and your deduction may be disallowed. To be alimony, a payment must meet certain requirements. To determine if the alimony payments you made are deductible, all of the following rules must apply. The payments are required by a divorce or separation instrument. You cannot file a joint return with the ex-spouse who paid you the alimony. The payment must be in cash, including check or money order. Your divorce or separation maintenance decree does not state that the payment is not alimony. You and your ex-spouse to whom you pay the alimony do not share the same household. There is no liability to make any payment in cash or property after the death of the recipient or ex-spouse, and the payment is not treated as child support. Please refer to IRS Publication 17, pages 132 through 134 for more information on the deductibility of alimony payments. And of course, in terms of identifying alimony, we covered that in one of our earlier sessions in this course. This is a good point to give you a password, and it's also an excellent point for you to push pause and take a break if you're feeling a need for one. I'm going to give you the password, the first password of the day, and this will be the password to unlock the Session 4 quiz answer key. And that password is Enterprise, as in the Starship Enterprise or the Aircraft Carrier Enterprise or the early prototype Space Shuttle Enterprise. The password is Enterprise. So let's move on to individual retirement accounts next, and this is probably one of the more complex calculations that we will teach you. Do not feel bad if you have a difficult time grasping the rules for deductibility of IRAs, because this is a common problem for many of our students. But I'll do the best job I can of explaining it and giving you lots of illustrations, and by the time I'm done, maybe you'll have a foggy understanding of it, and after a few more days or weeks of practice, it'll really sink in well. But we really are going to be hammering home multiple illustrations and giving you lots of opportunities in classwork, homework, and quiz assignments to really reinforce this concept. So individual retirement account, or IRA, if you make a contribution to your IRA, you can claim possibly a deduction for your contribution on Form 1040, and if you qualify, you claim it on line 32, right there. An individual retirement account is a trust or custodial account set up in the United States for the exclusive benefit of you or your beneficiaries. The account is created by a written document. The document must show that the account meets all of the following requirements. The trustee or custodian must be a bank, a federally insured credit union, a savings and loan association, or an entity approved by the IRS to act as trustee or custodian. The trustee or custodian generally cannot accept contributions of more than the deductible amount for the year. However, rollover contributions and employer contributions to a simplified employee pension, or SEP, can be more than this amount. Contributions except for rollover contributions must be in cash. You must have a non-forfeitable right to the amount at all times. Money in your account cannot be used to buy a life insurance policy. Assets in your account cannot be combined with other property except in a common trust fund or common investment fund. You must start receiving distributions by April 1st of the year following the year in which you reach age 70.5. Now, originally, there was only one kind of IRA. However, in recent years, new kinds of IRAs have been created, including Roth IRAs and educational IRAs. While there are tax advantages to investing in Roth IRAs and educational IRAs, only contributions to your traditional IRA are reported on your tax return. An IRA is a personal savings plan that offers you tax incentives to set aside money for your retirement. An education IRA allows you to set aside money for certain education expenses. So we're going to take a little bit closer look at the different types of IRAs, beginning with the traditional IRA and the rules that apply to making contributions to a traditional IRA, and whether or not you are allowed to take a deduction when you do make a contribution to your traditional IRA. The traditional IRA is the original IRA that was set up by the government to allow taxpayers the option of saving for retirement outside of their pension plans. A traditional IRA is any IRA that is not a Roth IRA, simple IRA, or an education IRA. In addition, an IRA is not a 401k plan. Earnings generated by money you invest in your IRA are tax deferred. This means you do not pay tax on your earnings until you withdraw them from your IRA. There are two advantages of investing in a traditional IRA. Number one, if you qualify, you may be able to deduct contributions you make to your IRA on Form 1040. And generally, the funds within your IRA are not taxed until you withdraw them. So who can make a contribution to a traditional IRA? You can set up and make contributions to a traditional IRA if you are under age 70.5 and you or your spouse, if married filing joint, had compensation during the year that you must include in your income. Compensation includes earned income from wages, commissions, or self-employment, alimony and separate maintenance payments you received, and military deferential pay and non-taxable combat pay. But compensation does not include interest, dividends, rental or investment income, pension or annuity income, deferred compensation payments postponed from a prior year, income from a partnership unless you provided services for the partnership that were income producing, Conservation Reserve Program payments reported on Schedule SE, or any amounts other than combat pay that you exclude from income, such as foreign earned income and housing costs. So let's look at what we mean by non-taxable combat pay. If you are a member of the U.S. Armed Forces, compensation includes any non-taxable combat pay you received. The amount should be shown in Box 12 of your 2010 Form W-2 with a code Q. So remember when we're talking about Box 12 and the different codes that can appear there, you do need to pay attention to code Q, because if code Q appears, it means that your client had non-taxable combat pay. So what is compensation for purposes of an IRA? Well, it includes wages, salaries, etc., commissions, self-employment income, alimony and separate maintenance, and military deferential pay. But compensation does not include earnings and profits from property, interest and dividend income, pension or annuity income, deferred compensation, or income from certain partnerships. So how can I contribute to my IRA, or how much can I contribute to my IRA? Well, you can contribute money in the form of cash, check, or money order to your IRA, and you can contribute the lesser of your compensation that you included in your income, or $5,000 if you were under age 50 in 2010, or $6,000 if you were age 50 or older in 2010. If you are married and you file a joint return, you can make an additional spousal contribution that is limited to the lesser of $5,000 if your spouse was under age 50 in 2010, or $6,000 if your spouse was age 50 or older. Your total compensation includable in gross income of both spouses for the year. So it's either the lesser of $5,000 or the total compensation that was includable in your income for the year for both spouses for the year. But that number goes up to $6,000 if you are age 60 or your spouse is age, if you are age 50 or older, if your spouse is age 50 or older. Now, the total maximum contribution is $10,000 if both you and your spouse were under age 50. It's $11,000 if one of you is age 50, and it's $12,000 if both of you were age 50 or older during the year. So when can I make a contribution? You can contribute money to your traditional IRA at any time during the year or by the due date of your return for that year, not including extensions. For 2010, the due date is therefore April 18, 2011. Now, I wanted to point out that this concept of when I can have an IRA and when can I contribute to my IRA can be a little bit difficult to grasp, and it's also sometimes not easy to get your clients to understand what the rules are. But if you've got a client who came into you during the 2011 tax season to prepare their 2010 return, you could advise them that they could go open up an IRA and make a contribution. And if their income is correct, they may be also able to take a deduction for the contribution they make to it. Now, they can make the contribution for 2010 and claim that deduction on their 2010, or they could make a contribution for 2011 and claim it on 2011's return. Now, theoretically, if your client did not make any contribution at all in 2010, they could walk into their bank, let's say in April of the tax season, and make a contribution of $5,000 for 2010 and make a second contribution of $5,000 and apply it to 2011. So thereby a single person who is under age 50 could put $10,000 into their IRA all at once during the year, and $5,000 could apply to the earlier year and $5,000 to the current year. But you could not, for example, have $5,000 that you put in your IRA during 2010 for 2010 and then go into your bank again in tax season 2011 and put another $5,000 in for the prior year. So the maximum amount allowed for any year is $5,000 if you are under age 50 and $6,000 if you are age 50 or older. But if you made no contribution for the earlier year and you've not yet made a contribution for the current year, you could, by the due date of your return, go in and contribute to both simultaneously. So how much can I deduct? Your allowable deduction depends on you or your spouse's modified adjusted gross income and whether or not you are covered by a pension plan at work. Note that if you contribute any money to a Roth IRA, you must reduce your IRA deduction by the amount you contributed to the Roth IRA. You must also reduce your IRA contribution by the amount you made to your Roth IRA. And here is an example. Bilbo, age 42, has adjusted gross income of $65,000. He contributed $3,000 to his Roth IRA during 2010. Bilbo has until April 18, 2011 to contribute a final $2,000 to either his Roth account or his traditional IRA account. So long as his total combined contributions do not exceed $5,000, it does not matter which account he chooses. Modified adjusted gross income for traditional IRA purposes is your AGI from line 37 of your Form 1040, page 1, plus your IRA deduction, your student loan interest deduction, your tuition and fees deduction, the domestic production activities deduction, the foreign earned income and or housing exclusion, exclusion of qualified bond interest shown on Form 8815 for higher education expenses, and exclusion of employer-paid adoption expenses shown on 8839. So what that is essentially saying is you go to the 1040 form and you look at your income shown on line 37. For modified adjusted gross income purposes, you're going to need to add back in certain amounts, and they include the IRA deduction itself, which would be reported on line 32. It would also include the student loan interest deduction, the domestic production activities deduction, and any amount that you excluded from income up here on line 21 for the foreign earned income exclusion. So essentially, if you're figuring your deductible IRA, adjustment items allowed up here typically are allowed when you're figuring that IRA deduction, but adjustment items in the lower part are not allowed when figuring the IRA deduction, at least in terms of the modified adjusted gross income calculation. Now, what makes the ability to claim a deduction issue confusing for tax preparers is when you get into these phase-out rules. And the phase-out rules are further complicated by whether or not you have an employer plan at work, because you are allowed a full deduction up to the lesser of $5,000 or $6,000 of age 50 or older, or 100% of your compensation. But if your spouse is covered by a pension plan at work and you are not, if you file a joint return, you can claim a full deduction for yourself if your modified adjusted gross income is $167,000 or less. If your modified adjusted gross income is greater than $167,000, however, your deduction will phase out, and the phase out occurs between $167,000 and $177,000 of income. Now, if you are married filing separate, your deduction is phased out between $0 and $10,000. Now, if you are covered by a pension plan and your filing status is single or head of household, you can claim a full deduction if your modified adjusted gross income is $56,000 or less. Your deduction is phased out between $56,000 and $66,000. If you are covered by a pension plan and your filing status is married filing joint or qualifying widower, you can claim a full deduction if your modified adjusted gross income is $89,000 or less, and your deduction is phased out between $89,000 and $109,000. So these concepts here, when you are not covered by a pension plan and when you are covered by a pension plan, and is your spouse covered by a plan or are you covered by a plan, those are what get people confused. So we're going to take a little bit closer look at that. And the starting point is looking at these two tables that come from Pub 17. These tables really do a nice job of summarizing the rules, and you have to bear in mind that there are two tables. The first table is the table you use if you are covered by a pension plan. The second table is the table you use if you are not covered by a pension plan. So take it from this perspective of each individual. And if you're looking at a taxpayer and a spouse, and you've got the taxpayer who is covered by a plan, you would use this table because you're looking at the taxpayer and whether or not he is covered by a plan. If you then go over to the spouse and say, is the spouse covered by a plan? And the answer is no, then you would go down here because this is the table if you are not covered by a plan. So you could have the taxpayer using this table, and you could have the spouse using this table, or vice versa. And it's important to pay attention to those details. So effect of modified adjusted gross income on your deduction if you are covered by a retirement plan at work. Well, if your filing status is single or head of household and your modified adjusted gross income is $56,000 or less, then you are allowed to take a full deduction. But if your income is more than $56,000 and less than $66,000, you are allowed only a partial deduction. And as soon as your income hits $66,000 or more, you are not allowed a deduction at all. Remember, this is if you are covered by a plan. If you are covered by a plan and you are married, then the income can be as high as $89,000 and you're still allowed a full deduction. But when the income goes over $89,000, you are allowed a partial deduction, and when your income hits $109,000, you are not allowed a deduction at all. If you are married filing separately and you are covered by a pension plan at work and you earn less than $10,000, you are allowed a partial deduction. If you earn $10,000 or more, you are not allowed a deduction at all. Now, under the second table, we're saying effective modified adjusted gross income on your deduction if you are not covered by a plan. Well, if you are not covered by a plan, it does not matter how much you earn. You're allowed to earn any amount of money, say even $1 million, and you're still allowed a full deduction. If you are married filing jointly or separately and you have a spouse who is also not covered by a plan, you can jointly earn any amount of money and still be allowed a full deduction. But if you are married filing joint and you are not covered by a plan at work, but your spouse is, then we look to your income. And if your income is $167,000 or less, you are allowed a full deduction. But if your income is more than $167,000, then you are allowed only a partial deduction. And as soon as the income hits $177,000, you are not allowed a deduction at all. Now, if you are married filing separately with a spouse who is covered by a pension plan at work, then the income has to be less than $10,000 to even claim a partial deduction, and as soon as it hits $10,000, you are not allowed a deduction at all. And here is an illustration, actually a pretty detailed illustration of how we determine the deductibility of contributions to an IRA. The illustration involves David, age 45, and Jane, age 40, Peggotty, who are filing a joint return. Jane is a homemaker, and David earned $188,000 of wages. He is covered by an employer pension plan. David paid $15,000 of alimony during the year. The Peggottys will each contribute $5,000 to their respective IRAs. What is the amount of their IRA deduction? So the first thing that might be going through your mind is, well, can they put $10,000 in because their income was awfully high? And the answer is, yes, they can. He has $188,000 of wages, which means he has $188,000 of compensation. The maximum contribution is limited to $5,000 each, or their compensation. And there's no limit on the amount of compensation they can have. So they can put up to $10,000 in the plan, and let's assume they're going to. So what are they going to be allowed to deduct? And here we have the completed IRA deduction worksheet for line 32 for David and Jane Peggotty. The worksheet guides you through the various steps needed to figure the IRA deduction for a particular filer. It allows you to figure their modified adjusted gross income, and it helps you determine how far into the phase-out range they are on the phase-out of their deduction based on income. Now, the worksheet is not a form you have to fill out. In fact, if you understand how the modified adjusted gross income factor works and you understand how the phase-out works, you don't need the worksheet to figure the deductible amount of their IRA contribution. Simply don't need it. But we're going to show you the worksheet and how it works, and then we're going to explain how to get the same number without using the worksheet at all. And our classwork assignment, which we'll do after we're finished with this illustration, is going to give you more opportunity to figure phase-out amounts without using the worksheet at all. Because the worksheet has a lot of lines and it seems to be rather intimidating. It's a full two-page document to arrive at a simple number, and you really don't need it. But again, I'll show it to you so you can see how it works. So firstly, we name the taxpayer and spouse, and they are David and Jane Peggotty. And then we look at the taxpayer first, and the taxpayer, the question is, are you covered by a pension plan? And the answer is, yes, David is covered. We then go over to the spouse IRA. Does the spouse have a pension plan at work? And the answer is no, the spouse is not covered by a pension plan. So we have yes for David and no for Jane. The next step is to figure their modified adjusted gross income. And the first thing the form asks for is the amount of income shown on line 22 of the Form 1040. The only income that they had was $188,000 of wages. We then are allowed to claim certain modifying items or adjustment items, and one of the adjustment items that they are allowed to claim is alimony, and they in fact had alimony as an expense. So their modified adjusted gross income for both David and Jane Peggotty is $173,000, and we enter that on line 5A and 5B of the form. Now on line 2A, we're going to look to their filing status and whether or not they are covered by a pension plan at work to determine what number to enter on line 2A. And you can see it says over here, married filing jointly, enter $109,000 in both columns. But if you checked no on either 1A or 1B, enter $177,000 for the person who was not covered by a plan. So we're going to enter $109 for David because he was covered by a plan. We're going to enter $177 for Jane because she was not covered by a plan. Now, David's modified adjusted gross income of $173,000 is greater than the amount shown on line 2A of $109,000. He is not eligible to claim a deduction for his IRA contribution as a result. But Jane's modified adjusted gross income of $173,000 is less than the amount shown on line 2B of $177,000. So Jane is eligible to claim a deduction for her IRA contribution. But if you recall, the phase-out for a married person who is not covered by a plan but has a spouse who is, that phase-out is $167,000 to $177,000. And so Jane is falling in that phase-out with income at $173,000, and what the formula has you do is subtract $173,000 from $177,000, and you get $4,000. Now in David's case, you get 0, so you enter 0 in his column and $4,000 in Jane's. So line 6A, line 2A minus 5A shows that David is not going to be allowed an IRA deduction at all. This is not saying he's not allowed to put money into his IRA, because he is. He can put $5,000 into his IRA, but he is not allowed to claim a deduction for that. On line 6B, we take 2B minus 5B, and this shows that Jane is allowed a partial deduction. If the amount on line 6B were $10,000 or more, Jane would be allowed a full deduction. But the amount on line 6B is only $4,000, and so Jane is going to be allowed a partial deduction. Now, $4,000 is 40% of $10,000. Well, where does that $10,000 come from? Well, let's just draw this right on the sheet for you here. If we take 167,000, actually let's make it 177, and subtract out 167,000, we get $10,000. So in effect, you can say that the phase-out range is $10,000, and when you're dealing with the deductibility of an IRA contribution, you're going to look at how far into that phase-out range a person is. So $4,000, we're going to take that and subtract that from 177, and we can say that 40% of the deduction is left, or that they are 60% of their way into the phase-out range. In any event, they're allowed 40% of the maximum IRA deduction based on their age, and so we're going to take 40% of $5,000 and get $2,000. That is the deduction, and I figured that without even getting to page 2. But let's move over to page 2 and see how that works. Here we have page 2, and on page 2, we pull over a number. And let's see what that number is. It's ultimately $2,000, and where do we get that? Married filing jointly or qualifying widower multiplied by 25% or by 30% in the column for the IRA of the person who is age 50 or older at the end of 2010. But if you checked no on either line A or line 1B, then in the column for the IRA of the person who was not covered by a retirement account, multiply the amount by 50%. And it's 60% if you're age 50 or older. Well, Jane is not age 50 or older. She is under age 50. So we're going to take the amount that we entered on the previous page here on line 6B and multiply that by 50%. When we do so, we get $2,000. And didn't I just tell you that she was going to be allowed about $2,000 of her deduction? So we already, before we even got to page 2, knew that the deduction would be $2,000. And that's the amount that she's allowed to claim. So let's just summarize what is going on the worksheet. And if you understand what's going on the worksheet, then you don't need it for the future. The IRA deduction worksheet is used to calculate the allowable IRA deduction for a person who is covered by a pension plan at work, or who is married to a person with a pension plan at work. The worksheet applies phase-outs for each filing status based on income and provides space for computing modified adjusted gross income. Use of the worksheet is not required, however, and it is possible to calculate a person's allowable deduction without using the worksheet. The Pegady's allowable contribution can be figured without the 8606 worksheet or the line 32 worksheet as follows. Take the Pegady's modified adjusted gross income of $173,000 and determine how far into the phase-out range the Pegady's are. David's phase-out is $89,000 to $99,000. Since his income is higher than this, he gets no deduction. Jane's phase-out range is $167,000 to $177,000, and she will be entitled to a partial deduction. The Pegady's joint modified AGI is $173,000, and the phase-out range for a married filer who is not covered by a pension plan but has a spouse who is covered is $167,000 to $177,000. Subtract the Pegady's modified adjusted gross income from $177,000. So you take $177,000 minus $173,000 and we get $4,000. The phase-out range for the IRA deduction is $10,000. 4 over $10,000 times $5,000 equals $2,000. Jane's IRA deduction is therefore $2,000. It's as simple as that. Now, how do you report non-deductible contributions to your IRA? Well, we covered that a little bit in session 5, didn't we? I explained to you that Form 8606 was used for 2 purposes. One, to report non-deductible contributions that you make into your IRA, and the other is to claim or report partially taxable distributions from your IRA. So your IRA deduction is limited, or if your IRA deduction is not limited, or pardon me, if your IRA deduction is limited or not allowed, you must file Form 8606 and attach it to your return. You use the form to figure the deductible portion of your contribution and to report your IRA basis to the IRS. If you are not required to file a tax return, you must still file Form 8606 if you made non-deductible contributions to your traditional IRA. Now, there are certain acts revolving around IRAs that can result in penalties. You will be penalized for any of the following acts relating to your traditional IRA. Number 1, your IRA invests in collectibles, or you take an early distribution from your IRA, or you allow excess amounts to accumulate in your IRA, or you borrow money from your IRA, buy property for personal use with IRA funds, sell property to your IRA, receive unreasonable compensation for managing your IRA, or you use your IRA as collateral for a loan. There's also something we need to talk about called qualified reservist distributions. If you live in a town with a high concentration of military people, this probably will come up quite often. A qualified reservist distribution is not subject to the additional tax on early distributions. A distribution you receive as a qualified reservist distribution, a distribution you receive is a qualified reservist distribution if the following requirements are met. You were ordered or called to active duty after September 11, 2001. You were ordered or called to active duty for a period of more than 179 days or for an indefinite period because you are a member of a reserve component. The distribution is from an IRA or from amounts attributable to elective deferrals under a Section 401k or 403b plan or a similar arrangement. And the distribution was made no earlier than the date of the order or call to active duty and no later than the close of the active duty period. So what this is saying is if you are a reservist and you're called to active duty and you remove money from your IRA or from your pension plan, you're not going to have to pay the early withdrawal penalty on that. Now, what is the reserve component? The term reserve component means Army Reserve National Guard of the United States, Army Reserve, Naval Reserve, Marine Corps Reserve, Air National Guard of the United States, Air Force Reserve, or the Coast Guard Reserve. Let's talk now about basis in inherited IRAs. If you inherit a traditional IRA from a person who had a basis in the IRA because he or she made non-deductible contributions, that basis that they made remains with the IRA that you inherit from them. So under inherited IRAs, there are some rules that you need to know, and let's look first at the rules for spouse of a decedent. If you are the decedent's spouse, you can choose to treat the IRA as a separate inherited IRA or as your own IRA. If you roll the funds over to your own IRA, you can combine the basis of your spouse's IRAs with the basis of your own IRAs. If you choose to treat your spouse's IRA as your own IRA, you cannot take distributions from the IRA until you reach age 59.5. You can also choose not to roll the IRA over or elect to treat the IRA as your own. And if you do that, you are allowed to take distributions from the plan before you reach age 59.5. So as a spouse, you have a choice. You can keep your spouse's IRA separate from your own and begin taking withdrawals from it at any time, or you can roll it over and combine it with your own IRA. Now, inherited rules or inherited IRA rules for people who are not spouses, or in other words, non-spouse beneficiaries. If you are not the spouse of the decedent, You cannot combine the basis of an inherited IRA with any basis you have in your own traditional IRAs or any basis in traditional IRAs you inherit from other decedents. If you take distributions for both an inherited IRA and your IRA, and each has basis, you must complete separate Forms 8606 to determine the taxable and non-taxable portions of those distributions. The 10% early distribution tax does not apply to distributions. You cannot make contributions to an inherited IRA, and you can make a trustee-to-trustee transfer of the inherited IRA to a newly created inherited IRA at a different financial institution. So the IRA will always remain an inherited IRA, but you can roll it over for a trustee transfer from one financial institution to another. That is okay. Now we're going to look at Roth IRAs. And really, Roth IRA contributions don't go anywhere on your tax return. They are not reportable on a tax return, but it's still your job as a tax preparer to understand what they are and how they work, because they impact the traditional IRA contribution limits. As well, you just may, in the conversation with your client, find out that they put money into a Roth IRA, and if they did, you might be looking at their income limits and to make sure that they were even qualified to do so. So rules for Roth and traditional IRAs are the same with the following exceptions. There is no age limit for contributing to a Roth IRA. There is no deduction that is allowed if you make a Roth IRA contribution. You do not report Roth IRA contributions on your tax return. Income limits apply to Roth IRAs, and they are different than the income limits that apply to traditional IRAs. Your allowable contribution phases out when your income is between $105,000 and $120,000 for single, head of household, or married filing separately, and you did not live with your spouse at any time during the year. The limit is $167,000 to $177,000 for married filing joint and qualifying widower, and $0 to $10,000 for married filing separately if you lived with your spouse at any time during the year. Now remember, if you contribute to a traditional IRA, you need to have compensation. And as long as you have compensation, there's no limit on the amount in terms of how much compensation you can have, but that would force you to no longer be allowed to make contributions to a traditional IRA. But the same rule is not the case with Roth IRAs. On Roth IRAs, you do have to be concerned about that upper income limit. Of course, you have to have compensation, but you also have to be concerned about your upper overall modified adjusted gross income. And if your income is too high, you are not allowed to make a contribution to a Roth IRA. Other rules that apply to Roth IRAs: you are not required to take a distribution from a Roth IRA when you reach age 70 and a half. Also, qualified distributions from your Roth IRA are not taxable. A qualified distribution is any distribution that occurs 5 years after the first year in which you make a contribution, and that is made on or after the date you reach age 59 and a half, or because you are disabled, or to a beneficiary or to your estate after your death, or to pay certain qualified first-time homebuyer amounts. The next type of IRA we're going to look at is also not reported on your tax return, but it's still one that you should understand and know about and be able to explain to your clients, because they are more than likely going to ask you at some point. That is a Coverdell ESA, or Coverdell Education Savings Account. An ESA is a trust or custodial account created to pay the qualified higher education expenses of a beneficiary who is under the age of 18 or is a special needs beneficiary. Amounts in the account grow tax-free until they are distributed, and the following rules apply to education savings accounts. The account must be organized in the United States and be designated as a Coverdell ESA when it is created. Any individual can contribute money to a Coverdell ESA. However, the total amount contributed to any one beneficiary during the year cannot exceed $2,000. The amount you can contribute phases out when your modified adjusted gross income reaches these ranges: $95,000 to $110,000 for a single, married filing separate, head of household and qualifying widow, and $190,000 to $220,000 for married filing joint. Distributions can be made to pay qualified education expenses of the beneficiary and are generally tax-free. Qualified expenses include elementary, secondary, undergraduate, and graduate level studies. A 10% additional tax applies to distributions that are greater than the qualified educational expenses of the beneficiary. You can roll over assets from the beneficiary's Coverdell ESA to the Coverdell ESA of certain family members. Generally, assets remaining must be distributed when the beneficiary dies or reaches age 30. The due date for contribution to an ESA is the due date for filing your return, not including extensions. So this is a good point to take a break and do a classwork assignment, just kind of to break away from my voice. And I'll also use this opportunity to give you the second password of the day. The second password I'm going to give you is the password to unlock the Session 5 homework answer key, and that password is Wellington. So let me just jot that down here for you. And Wellington is the capital city of New Zealand. So last class I gave you the name Auckland, which is the largest city in New Zealand. Wellington happens to be the capital of New Zealand, and it is the second password that I am giving you today. And there it is. Okay, so at this point, what I'd like you to do is break and take the Session 1 classwork assignment. And I'm just going to flash down to where that assignment appears in your manual. It is on page 34. The Classwork Assignment 1 asks you to... Okay, so here we are on page 34 of the manual, and your instructions are, what is the allowable deduction for each of the following taxpayers? So at this point, please push pause, work through problems 1 through 7, and then resume playback for a review of the answer key to these questions. So please push pause now and just work your way through the problems, and I will then review the answers with you. Okay, so now I'm ready to review the answers with you, and hopefully you've had some success in calculating your answers. We're going to take these one in at a time, and the first problem, Vicki Jones is single, and she earned $1,200 in wages and $6,000 in interest. Well, her maximum IRA deduction is going to be limited to the amount she's allowed to contribute, and she cannot contribute more than her compensation. Since her compensation was only $1,200, that's the maximum amount she can contribute, and that's the maximum amount of her deduction. Frank Ford is a married man, age 51. His wife, Betty, age 52, is an active participant in her company's retirement plan. Frank earned $45,000 and Betty earned $50,000. Well, if you are married filing joint and you are not covered by a plan, but you are married to a person who is, then your phase-out range on your joint return is going to be $167,000 to $177,000. And clearly, with income of $95,000, Frank's income is well below that. So he is age 51. That makes him eligible for the increased amount of contribution. He's allowed to put $6,000 into his IRA, and all $6,000 would be deductible. Now, things are a little bit different for Betty, though. Betty had income of $95,000, but the phase-out range for a married filing joint filer who is covered by a pension plan at work is $89,000 to $109,000. So you figure the amount she's allowed to deduct by subtracting her modified adjusted gross income from the maximum phase-out range amount. That maximum phase-out amount is $109,000. So we're going to go 109 minus 95, and that gives us $14,000. We then take 14 and divide that by 20, because that's the difference between her phase-out and the phase-out range, or how far into the phase-out range she is. So we're going to take 14, divide that by 20, multiply it by 6,000, and that makes her allowable contribution $4,200. Actually, her allowable deduction $4,200. And if she contributes $6,000, she will need to report $1,800 of non-deductible contributions on Form 8606. Next up, Jerry is single and age 50. His adjusted gross income for 2010 is $25,000, all of it from his share of income in his partnership. Jerry's Schedule SE reported $25,000 of self-employment income. What is his maximum contribution for the year? Well, he is age 50. He is not covered by a pension plan at work. He can put a full $6,000 into his IRA, and he can deduct all $6,000 of it. Sally, age 45, is divorced, and she received $50,000 of alimony during the year, which was her only source of income. Remember, alimony, for purposes of the IRA deduction, is considered to be compensation. She is under age 50, so her contribution is limited to $5,000, but she is allowed to deduct all of it. Jack is age 49, and Mary is age 41. They are married. Jack works full-time at XYZ Inc., and he earned $150,000. He is eligible to participate in his employer's 401k plan, but did not make any contributions to the plan during the year. The Sanders modified AGI for the year is $158,000, and Mary did not work. What is Jack's maximum allowable IRA contribution? Well, this is something that really throws tax preparers and clients all the time. A taxpayer may have a pension plan at work, but for whatever reason they aren't participating in it, and they think because they're not participating in it that they can make a deductible contribution to their IRA. Well, the answer is, if the pension plan box is checked on your W-2, you are covered by a pension plan at work. And if you're covered by a pension plan at work, it does not matter whether you participated in it or not. The phase-out limits apply. And since the income is $158,000 and he is married and he is covered by a pension plan at work, his income is too high and he is not allowed to claim a deduction. So he could put $5,000 into his IRA, but none of it would be deductible. He would therefore need to file Form 8606 to report a $5,000 non-deductible contribution to his IRA. And finally, we have Mary, his wife. Well, her phase-out range is 167 to 177. The income is 158. She's not covered by a pension plan at work, and she is age 50 or older, so she is allowed to put $6,000 into her IRA, and she is allowed to deduct all of it. So let's move back in our manual to where we left off. And we are going to move on to the next topic of the day, which is student loan interest. Student loan interest is reported on line 33. You may be able to deduct interest you pay on a qualified student loan. This deduction is available whether or not the education is work-related. If you qualify, you can deduct up to $2,500 of student loan interest paid in 2010. You report the deduction as an adjustment to income on Form 1040, line 33, or Form 1040A, line 18. Qualified student loan interest includes student loan interest you paid for an eligible student who was yourself, your spouse, or any individual who was your dependent at the time the debt was incurred. The taxpayer must have the primary obligation to repay the loan and actually pay the interest during the year for it to be deductible. An eligible student must take at least 1/2 the normal full-time load in a degree, certificate, or other qualified program at an educational or eligible institution. Interest must be on a loan that was used to pay for tuition, fees, room and board, books, equipment, and transportation while attending an eligible institution. I'm just going to highlight this room and board thing for a moment, because room and board is something that normally does not qualify for a deduction when we're talking about the deductibility of education expenses. But this is not a question of the deductibility of education expenses. Rather, it's a question of, is a student loan that was used to pay for higher education, is the interest on it deductible? And the interest on a student loan is deductible if the loan was used to pay for tuition fees, room board, books, equipment, and transportation while attending an eligible educational institution. So there are more things that qualify for deductibility under the student loan interest rules than qualify for deductibility under the actual education expense deduction. Next, an educational or an eligible institution includes colleges, vocational schools, or other post-secondary institutions that are eligible to participate in Department of Education student aid programs. The deduction phases out when your modified adjusted gross income is between these amounts, $120,000 and $150,000 if you are married filing joint. If you are married filing separate, you are not allowed a deduction at all. And if you are single, head of household, or qualifying widow, your phase-out is $60,000 to $75,000. Remember that modified adjusted gross income amounts excluded from income on Form 2555 and income for residents of American and Samoa cannot be excluded from your modified AGI. So when you're figuring your modified adjusted gross income for purposes of the qualified student loan interest deduction, you would have to add back in any amount excluded from income under the foreign earned income exclusion. I should point out that the modified adjusted gross income definition varies according to what kind of deduction we're looking at. So modified adjusted gross income for purposes of the IRA deduction has a different definition than modified adjusted gross income for purposes of the student loan interest deduction. There are some restrictions that apply to student loan interest. You are not allowed to claim a deduction for your student loan interest expense if any of the following is true. You are claimed as a dependent on another person's return, or your filing status is married filing separate, or the loan was made under a qualified employer plan. This can create a problem in that student loan interest will not be deductible when a parent claims a student as a dependent if that dependent has the primary obligation to repay the loan. If the dependent is claimed on the parent's return, then he or she will not be able to claim the deduction either. The next deduction we're going to talk about is the tuition and fees deduction, and that is claimed on line 34 of the 1040 form. You can claim a deduction of up to $4,000 for qualified tuition and related expenses at an eligible educational institution. These expenses can be paid for you, your spouse, or your dependent. Qualified higher education expenses are, of course, limited, and to qualify for this deduction, all of the following must be true. The qualifying amounts include only tuition and related fees paid directly to the institution as a condition of enrollment. For example, Jane enrolls in a course at her local community college and she pays the following expenses: tuition of $150, a program fee of $20, books purchased at the college bookstore of $60, and a parking permit of $15. The total expenses that she paid are $245, but of those expenses, only the tuition and the program fee are deductible, and that means $170 is deductible. So Jane is required to pay $170 for tuition and program fees prior to enrollment. Required reading for the course includes books Jane must purchase. Jane also pays for a parking permit to park on campus while she is attending class. But because Jane is not required to purchase her books directly from the community college as a condition of enrollment, she cannot deduct their cost. Similarly, she cannot deduct her parking expenses because it was not a condition of enrollment. Example number 2. Sally enrolls in a basic tax course offered through a licensed vocational school. She must pay the following expenses directly to the school as a condition of enrollment. The tuition is $250, the enrollment fee is $29, and the books and supplies are $320. The total cost of the course and books is $599. Sally is able to deduct the full $599 because the entire fee is paid directly to the school as a condition of enrollment. The tuition must have been paid for you, your spouse, or a person whom you are claiming as a dependent on your return. And I also want to highlight something here because the word is for you. It is not by you. So we've highlighted it already. I'm going to put another box around it just to specifically point out that the tuition has to have been paid for you, or your spouse, or a person you are claiming on your tax return as a dependent. It does not say you have to have paid it. So it could have been paid by a friend or a relative, and it's still deductible. The tuition expenses are deductible if they are paid by you, your spouse, your parent, or another person on your behalf, or through proceeds from student loans or financial aid programs, so long as the amounts borrowed must be repaid at some point in the future. But tuition expenses are not deductible if they were paid by your employer or they were paid through a scholarship or fellowship grant that you are not required to repay. Also, payment for tuition and fees must have been made during 2010 for education that began in 2010 or in the first 3 months of 2011. And the tuition must have been paid to an eligible institution. An eligible institution is any college, university, vocational school, or other post-secondary educational institution eligible to participate in student aid program administered by the U.S. Department of Education. Certain educational institutions located outside of the United States also participate in the U.S. Department of Education's federal student aid or FSA programs. So what are some non-qualified educational expenses? Well, you cannot claim a deduction for any of the following expenses: insurance, medical expenses including student health fees, room and board, transportation, personal living or family expenses, expenses paid by your employer or reimbursed to you by your employer, expenses paid by tax-free educational assistance from sources such as scholarships, Pell Grants, and Veterans Educational Assistance. You may not claim the deduction for expenses that were not in excess of interest from U.S. savings bonds used to pay for higher education that is excluded from income. So what we mean by that is, let's just suppose you cashed in some savings bonds. You cashed in $5,000 of savings bonds, and you spent the savings bonds on higher education. Well, to the extent you have higher education expenses that were paid for through these bonds, you cannot claim a deduction. Now let's just suppose your education expenses were $7,000. If your expenses were $7,000 and the bond interest that you exclude from income is $5,000, then that would leave you with a deductible amount, and the deductible amount would be the difference between these two numbers, or $2,000. The next rule that we look at is that you cannot claim a deduction for expenses that were not in excess of tax-free distributions from a covered LESA. So if you take money out of your education savings account and use that money to pay for qualifying education expenses, and you exclude that distribution from your income, then you are not going to be able to claim a deduction to the extent that you have this excluded income, unless your education expenses are more than the excluded income. Of course, you can make an election to treat a distribution as taxable, but we'll talk about that a little bit later in the course. Also, tax-free distributions from qualified state tuition programs, or QTPs. If you took a distribution from one of those programs, you are not allowed to claim a deduction on the 1040 form unless the expense for qualifying costs exceeds the amount of the tax-free distribution. Also, you cannot claim a deduction for expenses for books, supplies, and equipment. These are not deductible unless the cost of these items is paid directly to the institution as a condition of enrollment, as we already said. You cannot claim the educational expense deduction if your filing status is married filing joint, or another person claims your exemption on their return, or you file Form 1040-NR, or your modified adjusted gross income is more than $80,000 or twice that amount if you are married filing joint, or you are claiming the American Opportunity or Lifetime Learning credits for expenses of the same student that you are using to claim this deduction. And here's an illustration of what we mean by that. Robin Loxley has two sons, John and Will. The qualified tuition paid for John totaled $4,000 and Will's tuition was $5,000. Robin could claim an educational expense deduction for either child. However, if he claims a $4,000 deduction for John, he can also claim an education credit for John. Education credits are going to be covered later in our course when we, of course, get to credits. Tuition and fees deduction limits. Well, firstly, we look at the education limit or the deduction that is allowed. And there is a $4,000 deduction and a $2,000 deduction, and how much you are allowed or limited to depends on your filing status and your income. If you are single, head of household, or qualifying widow, and your income is between $0 and $65,000, your deduction is limited to $4,000. If you are married filing joint and your income is anywhere from $0 to $130,000, your deduction is also limited to $4,000. But if your income goes above $65,000 or above $130,000 for married filing joint, then the deduction is only limited to $2,000. And if your income hits $80,000 or $160,000 for married filing joint, then you're not allowed a deduction at all. Also, the deduction is not allowed for married filing separate filers or for any taxpayer claimed as a dependent on another payer's tax return. Note that the adjusted gross income phase-out works in steps. Thus, a married taxpayer with $4,000 of qualifying educational expenses and modified adjusted gross income of $130,000 in 2010 would be entitled to a full $4,000 deduction. But if that same filer had just $1 more of income, then the deduction is reduced to $2,000. So how do you go about claiming the deduction? Well, you claim your allowable tuition and fees deduction on line 34 of Form 1040 or on line 19 of Form 1040A, and you must complete and attach Form 8919 to your tax return. And here we have a sample 8919 filled out for you. You can see that we have Sally Student. We enter her name. She's filing and claiming this deduction for herself. The name of the filer is shown up here. The name of the student is shown here. The Social Security number of the student and the qualified expenses for that student. The next step is to show the income of the filer. The income of the filer is $30,000. That puts her in a range where she's not limited based on her income. She will be allowed a full deduction. And of course, the $4,000 you see here on line 6 will carry over and get entered here on line 34 of the 1040 form. We're really basically finished with the described items for the most part on the 1040 form. You'll see that line 35 describes an adjustment to income item called the Domestic Production Activities Deduction. That deduction is specifically related to business income, and so we're reserving any coverage of this particular topic until we get to our session on self-employment. But if you do qualify for the Domestic Production Activities Deduction, you enter that on line 35. The next line we come to is line 36, and you'll see that line 36 says add lines 23 through 31A and 32 through 35 and enter the total. But there's also some rules that we're going to discuss that allow you to enter some specific additional adjustments to income right on the line. So you'd actually be able to type additional deduction items straight on line 36, and we're going to show you how that works next. So other allowable adjustments are entered directly on line 36, and there are a number of write-in adjustments which may be deducted on line 36. To claim one of these deductions, enter the amount of the deduction and a description of the deduction on the dotted line next to line 36. Identify the deduction as follows. The first item is jury pay. If you gave your jury pay to your employer because your employer paid you for the time you spent on jury duty, deduct the amount you paid your employer here. So let's look at what we're talking about. We have a filer who has $80,000 of income, and we're essentially saying that in that $80,000, income is included that was paid to this employee by his or her employer while they were on jury duty. And as a condition of that, this employee had to turn over their jury pay to their employer. Well, the jury pay still has to be included in income, and it's included in income on line 21, $200. So if the employee received $200 of jury pay while they're on jury duty, but their employer paid them while they were on jury duty, then that employee would pay the $200 to the employer. And since the employee is including it in income here, but they're not getting to keep it, they're allowed to enter jury pay directly on line 36. They would enter the amount of jury pay they paid their employer, and then they include that as their in their adjusted gross income. So the adjusted gross income would be reduced by the amount of jury pay. So we see here income was 80, we add 200 and we get 80,200. We subtract 200 out and we're right back to 80,000 where we started. The next item in line is subpay TRA. This is obviously a very select group of people when you hear what it's about. If you repaid supplemental unemployment benefits under the Trade Act of 1974, you may deduct the repayment on line 36. See IRS Publication 525 for details about the specific type of unemployment benefit that qualifies for this deduction. And what I'm telling you is the average everyday unemployment benefit that people get, that's not subpay TRA and doesn't qualify. UDC, this has to do with legal expenses from unlawful discrimination claims. Unlawful discrimination claim, that's the UDC. If you paid attorney fees for actions settled or decided after October 22, 2004 involving certain unlawful discrimination claims, you may deduct these expenses on line 36 to the extent of gross income that you received from the action. Now, to make this make more sense to you, what you need to know is that in general, if you sue someone for injury of any kind and you win, so basically you feel that you've been harmed or wronged, and you win, typically if you've had an attorney involved, they're going to take 30%. But let's just suppose you're involved in a lawsuit and you win, and your employer has helped you in this lawsuit and you win, let's just make up a number here, you win $100,000 in this lawsuit. Okay, Typically, the attorney will take 30% of that, or in this case, $30,000. And that will leave you with a net of $70,000 from the settlement. Well, where do you report settlement wins like this? Well, if you have a settlement, you're going to enter that settlement as income on line 21 of your Form 1040. So ultimately, what would happen is you would report $100,000 of settlement win on line 21 of Form 1040. Okay? So you enter your win of $100,000 on 1040, and if you were allowed to claim a deduction for the attorney fees, ultimately you would claim those, in most cases, on Schedule A as a miscellaneous itemized deduction. Well, claiming a deduction on Schedule A is not nearly as advantageous as being able to claim the deduction as an adjustment to income. But there is only one circumstance in which attorney fees can be claimed as an adjustment to income on the front page of the 1040 form, and that situation is when you are dealing with an unlawful discrimination claim. And if you believe that you have a client that has won money under an unlawful discrimination claim, then you can go ahead and enter those attorney fees as an above-the-line deduction on line 36. That is the only situation, however. And moving on to page 33 of our manual, we are on to the last two types of adjustment items that we're going to discuss with you today. The first of these is PPR, or personal property rental. If you received income from the rental of personal property and you were not in the business of renting such property, enter the amount of income you received on Form 1040, line 21, as other income. You deduct the expenses relating to the property on line 36. So what is personal property rental? Well, you've got something called real estate rental. That would be like renting out a house or an apartment, for example. But maybe, I don't know, you have a fifth wheel or a travel trailer, and you decide to rent that out because some friends of yours have come along and said, gee, that's a nice fifth wheel, or gee, that's a nice travel trailer, or even, gee, that's a nice motorhome. We'd like to rent it from you for a couple weeks and go on a vacation. And you go, well, it's just sitting in my garage anyway. Sure, I'll take the money. Well, guess what? That money is taxable, and it's taxable as personal property rental. Now, if you're not in the business of renting personal property, such as a rent-to-own type business, you do not need to file a Schedule C for this. Instead, you just report the personal property rental income on your tax return, and you enter it on line 21 as personal property rental. Now, let's just suppose that associated with that motorhome for the period of time, or the travel trailer for the period of time you've rented it, you managed to come up with or have $2,000 of expenses that are associated with it, repairs or some issue that came up that you had to have an expense directly related to that item while it was being rented. Those expenses are claimed on line 36, and you would enter PPR for personal property rental expenses and then carry the deduction over to line 36. And finally, WFB, if you paid attorney fees or court costs in connection with an award from the IRS for information leading to the detection of tax law violations, you may be eligible for this deduction. See instructions for 2010 Form 1040, page 33. All right. So we've already taken a look at classwork number 2. Let's move on to the next part of today's classwork, which is classwork number 2. And classwork number 2 is a much more complex assignment for you. Instead of just working through a few scenarios, we're actually going to have you do a tax return. And this tax return involves a number of forms. It includes 1040, 3903, 8606, 8917, and of course the IRA deduction worksheet. The scenario involves George Kelly, who is a high school teacher, and his wife Darla, who is a homemaker. They are filing a joint return. They moved from Seattle, Washington to Boise, Idaho in an employer-required move. George and Darla drove their car to their new home. George's employer reimbursed 75% of his allowable moving expenses, and the Kellys' moving expenses were as follows. House hunting, $300. Cost of moving household goods, $2,000. The cost of disconnecting utilities, $50. The distance from their Seattle home to their Boise home is 501 miles, and the distance from the Seattle home to the work location in Seattle is 20 miles. Their distance from their Seattle home to their Boise job is 515 miles. Darla did not work, and during the year she received U.S. savings bond interest of $700 and Port of Seattle bond interest of $800. The Kellys will each contribute $5,000 to their IRAs. George's IRA basis for 2009 was $4,000, and his IRA's value on 12/31 of 10 was $9,000. Darla has no basis in her account. George spent $400 on classroom supplies and paid $800 for continuing education at SCC during the year. He also paid $600 of student loan interest. Darla also paid $2,000 of qualifying student loan interest. The Kellys will receive the Making Work Pay Credit in the amount of $800. Please prepare their tax return. So at this point, please push pause on video playback, and when you are ready, we will review the Session 6 Classwork 2 answer key together. Okay, we're now ready to review the Classwork 2 answer key, and I wanted to give you the password to unlock the answer keys for Session 6. Both answer keys will use the same password, and the password is COB. So we've given you 3 passwords today. The final password is COB, and you use it to unlock both answer keys for the Classwork assignment for Session 6. So let's take a look at the key points. Firstly, just calculating the allowable moving expenses for our taxpayers. We have the cost of moving household goods, which is allowed in full, $2,000. Also the cost of disconnecting household utilities at $50, and we're looking at the distance they moved. 501 miles times 16.5 cents a mile gives us $83. So we've got total allowable expenses of $2,133. But the employer is reimbursing them 75%. So $1,600 is reimbursed, and $533 is allowed as an adjustment to income on line 26. When calculating a modified adjusted gross income for their IRA deduction, the Kellys use their gross income from Form 1040, line 22, and then subtract adjustments for their educator expense of $250, the moving expense of $533. So their modified adjusted gross income for purposes of their IRA deduction is going to be $98,700 minus $250 minus $533, or $97,917. And by now you should have figured out that, of course, the house hunting expenses were not deductible. So let's just take a look at the income and part of their tax return. They had a couple of W-2s, or they had a W-2 for the year, and the W-2 is for $98,000. And you saw that in the manual on page 36. We also have taxable interest of $700 and tax-exempt interest of $800, and that's where we get the $98,700 of income. We enter the educator expenses on line 33. We enter the deductible moving expenses on line 26. And next step was to figure the IRA deduction and the student loan interest deduction. So the student loan interest was allowed as a deduction in full. Okay. So here is Classwork 2 assignment. It involves preparation of Form 1040, Form 39 is a homemaker. They live at 2888 Southwest Boxman Drive in Boise, Idaho, and they are filing a joint. George's employer reimbursed 75% of his allowable moving expenses. The Kellys distance issues here, and the distance from the Seattle home to Boise is 501 miles. The distance from the Seattle home to the work location in Seattle is 20 miles, and the distance from the Seattle home to the Boise job is 515 miles. Darla did not contribute $5,000 to their IRAs. George's IRA basis for 2009 was $4,000, and his IRA value at the end of the year was $9,000. Darla has no basis in her account. George spent $400 on classroom supplies and paid $800 for continuing education at SCC during the year. He also paid $600 of student loan interest. Darla paid $2,000 of qualified student loan interest. The Kellys will receive a Making Work pay credit in the amount of $800. Prepare their tax return. So here are their income documents, and the first one that we look at is that we do have a Board of Education W-2 for George Kelly. We have a W-2 for George Kelly from the Board of Education in the amount of $98,000. The retirement plan box is checked, so based on his income, his ability to claim a deduction for contributions to his IRA is going to be limited. We also have a 1098E here that shows the amount of student loan interest that was paid by George during the year. We do not have a copy of a 1098E for his wife, however. It just seems to be told you that the amount of student loan interest that was paid by Darla Kelly is $2,000, so you want to remember that when you're working on the problem. We also have a 1098T here that shows the amount of qualified student expenses that were paid during the year, and that's going to factor in when you're figuring the student tuition and fees deduction for George for the year. So at this point, please push pause on the video playback, complete the Session 6 Classwork 2 Classwork assignment, and when you are ready, so if you are finished with the Classwork answer key password is COBB, C-O-B-B, and this password the allowable expenses for the Kellys include moving their household good to multiplied that by 16.5 cents, and we get $83. So the total allowable expenses are $2,130. George's employer reimbursed them 75% of that amount, so the allowable deduction will be $533. Educator expenses of $250 and moving expenses of $533. So their modified adjusted gross income for purposes of their IRA deduction take a look at the front part of their 1040 form. There's a lot going on here. You know, the simple stuff now like married filing joint and figuring their personal exemption numbers and entering those. That should be pretty straightforward. The next step is to enter the W-2 income, $98,000. On line 8A, we enter the U.S. bond interest. On line 8B, we enter the Seattle bond interest. And the total income on line 22 is $98,700. Next, we look at educator expenses, and those are deductible. George enters the maximum allowable amount of $250. The moving expenses total $533, and we have to do a 3903 and attach that to the return. I'll show you that in just a minute. Down here on line 33, we're also allowed to claim a deduction for student loan interest. And even though the total student loan interest paid for the year was $2,600, $2,500 is the limit that can be entered on line 33. And there is an allowed tuition and fees deduction of $800 as well. We have to attach Form 8917 when we claim that. Line 32 is the IRA deduction, and the deduction that they are allowed to claim is $77.80. We need to do the worksheet to figure out how we get that number. So let's go take a look at all of these different forms right now together. Coming in order, the first form is Form 8606 actually, and that shows George's non-deductible contributions. But to figure out what those were, we need to do the worksheet, and that's going to come a little bit later. So we have 3903 for George and Darla Kelly. The amount of transportation expense and cost of moving the household goods was $2,050. The travel expense when they drove their car was $83. We add those two numbers together and we get $2,113. We then show the amount that was reimbursed by the employer and gives us that final deduction of $533. Moving down, the next form in line is the tuition and fees deduction. We enter the name of the filers, George and Darla Kelly. We enter the name of the student under the student line and the amount of qualified expenses. We then look at the income limits, and based on the income limits, they're not going to be affected in their ability to claim this $800. They are allowed to claim it in full. Making work pay credit. This is a form that we will talk about a little bit later in our course, but this is what the form looks like, and we've been kind of throwing that at you throughout the course. Now here's the more complex calculation that you did need to do, so let's see how that went for you. We first have the taxpayer, George. He is covered by a pension plan at work. We have Darla. She is not covered by a pension plan at work. So George's phase-out limit is $109,000. Darla's is $177,000. We then enter the income shown on line 22 of the Form 1040. That was $98,000. And we then add in or claim a deduction for certain deductible amounts. So it says enter the total of the amounts on Form 1040 line 23 through 31A plus any write-in amounts you entered on line 36. So let's go back up and see what those were. Those are the total of the moving expenses and the educator deduction. So when we take those two numbers, we get $783. Those are allowable modifications when we're calculating modified adjusted gross income for the Kellys. So we enter that $783 on line 4, and we subtract that from $98,700. When we do so, we get $97,917. We enter that for each of the two filers. We then look at where we fall on the income, and if we take 109 and subtract 97,917, we get $11,083. If we take 177 and subtract 97,917, we get $79,083. So we can see both filers here are entitled to at least a partial deduction. The next step is to go over to page 2. And on page 2, it says multiply line 6A and 6B by the percentage below that applies to you. If the result is not a multiple of 10, increase it to the next multiple of 10. For example, increase $490.30 to $500. If the result is $200 or more, enter the result, but if it's less than $200, enter $200. So if you're single or head of household or married filing separately, multiply by 50% or by 60% in the column for the IRA of the person who is age 50 or older at the end of 2010. Well, let's just see how old our filers are. We've got George, born in 1963. That would not make him, let me see, no, he would not be 50 yet. And Darla, age 62, is also not 50 yet. So they're going to be multiplying out by the 50% ratio if they're single. But if they're married, which they are, they're going to multiply by 25%. Or by 50% if they're not covered by a pension plan at work. So ultimately, Darla is limited to her $5,000 deduction, and that's where that number comes from. But for George, we're going to take $11,083 and multiply that by 25%, and that's where $2,780 comes from. Now, you could, of course, calculated this manually. In the end, Darla's allowed $5,000, George is allowed $2,780, and the difference between $2,780 and $5,000 is the amount that George cannot deduct, and so he will enter that difference on Form 8606. So let's go back up to 8606 for George. And we'll see that the amount he cannot deduct is $2,220. He already had a basis in his account from earlier years of $4,000. So now the new basis in his account is being increased. And the fair market value at the end of the year of his accounts is $9,000. And then we go back up to the 1040 form, and now we understand where the $7,780 is coming from. $5,000 is for Darla, and $2,780 is for George. We end up with total modifications to income of $11,863. Modified adjusted gross income, or rather adjusted gross income rather, is $86,837. And we go through and claim the usual standard deduction amount, the usual personal exemption amount, get the taxable income, go to the tax tables and figure the tax. The tax comes out at $9,394. Here's the withholdings and credits, and ultimately the Kellys owe $1,094 when they file their return. So that is the last bit of today's class. Just the final piece to review is the homework assignment. So let me pull back up the manual. And we'll just scroll down to the homework assignment. And there are two homework assignments. The first homework assignment is to figure the maximum contribution for a Roth IRA for the following taxpayers. Take a look at their filing status and their income and determine how much they are allowed to contribute to their Roth IRA. Then in problem number B, we have Leah Solo, who is a nurse and married to Han Solo, who is an airline pilot. Han's employer paid all of their moving expenses for them, and they reside at 6060 Millennium Drive in Charlotte, North Carolina. Their daughter, Alexandra, lived with them all year. Han contributed $2,500 to his qualified family coverage health savings account during the year. His annual HSA deductible is $5,000. During the year, he withdrew $2,000 to pay for unreimbursed qualified medical expenses. Leah and Han want to make the maximum deductible contributions they can, and then they want to contribute the balance to their allowable contributions to their Roth IRAs. They have not made non-deductible contributions in prior years. During the year, Leah paid $1,500 of qualified student loan interest and received $12,000 of unemployment. The Solos will receive a Making Work pay credit in the amount of $800. Their W-2s and their 1099-R are attached. Prepare their federal return, and then answer questions 5 through 17. So here we have $46,000 of income for Han. The retirement plan box is checked. And what's this code W about? You'll need to look that up if you don't remember. Then moving on, we have a second W-2 for Leah. She earned $40,000. Her retirement plan box is not checked. We have Rebellion Incorporated, 1099-R. Someone took money out of a pension plan, and that was Han. And that's it. So that concludes session 6 of the basic tax course. Have fun with your homework and reading assignments, and I'll see you back here again for session 7. Bye-bye.